$2 billion. If you had $2 billion of venture capital money, would you invest that into a breakthrough pharmaceutical drug? A drug that can cure cancer, eradicate diabetes, rewrite human genetics. The drug is a miracle, and after the first pill, the cost to manufacture is near zero, and the world is your potential customer. Or would you spend the same $2 billion to deliver a bag of potatoes to someone's doorstep in 10 minutes? Venture capital was designed with one purpose: to fund ideas too radical for a bank to touch. The chip that might not compile, the software that might crash, the biotech that might fail. It worked. Intel, Apple, Microsoft. The product was the value. These companies didn't need billions to attract customers. They built things that people actually needed. And when they went public, they made everyday retail investors wealthy for generations. Then came 2008. Interest rates went to zero. Trillions flooded into venture capital. And the industry grew too large for its own discipline. Firms stopped backing geniuses building new technology and started backing aggregators to monopolize things that already existed. Food, cabs, groceries, things your neighborhood kirana, your auto driver, your corner sabji vendor had been doing profitably for decades. The only difference, the aggregator would do it at a massive loss until every competitor was dead. This is the model BigBasket was built on. In 2011, 5 friends pooled in around $1 crore of personal capital and built BigBasket. The idea was simple: deliver groceries to your door the next day. Scheduled slots, predictable logistics, a reliable cold chain from farm to doorstep, and yes, potatoes. This man accidentally wrote the pitch deck for India's first online grocery unicorn. Over the next decade, they didn't fund the growth through profits. They funded it through nearly $1 billion of capital raised. The playbook was clear. Their job was not to make the company profitable. It was to explode top-line revenue, expand into more cities, dress up the spreadsheet, and then find the next investor. In 2018, Alibaba led a $300 million Series C into BigBasket. In 2019, a further $150 million Series F officially pushed BigBasket past that $1 billion valuation mark. But underneath the valuation headline, the unit economics were broken. The business was burning money on regional cold storage warehouses, last mile delivery, and relentless customer discounts. Venture capital had quietly figured out one hard truth it would never say in a press release: the consumer will never pay the true cost of delivering a potato to their door. The business cannot generate profits on its own. So how do investors get their money back? They find a corporate buyer. Modern consumer venture capital runs on a very specific playbook. You find a business that cannot survive on its own operational profits. You pump in round after round of external cash to sell at lower prices, systematically undercutting every neighborhood kirana and every traditional grocer. You expand the addressable market on paper, and then you wait. You wait for the ultimate exit, a corporate buyer or a stock exchange listing where the retail public is left holding the bag. An ancient Indian epic gives us the perfect word for what this creates: Trishanku Swarga. In the Balkanda of Valmiki Ramayana, King Trishanku wanted to reach heaven in his mortal body. Sage Vishwamitra used his immense powers to launch him upwards, but the gods rejected him at the gates of heaven and hurled him down. Refusing to let him crash, Vishwamitra used endless blasts of energy to keep the king suspended mid-air, trapped between heaven and earth, going nowhere. A business that cannot generate profits belongs to earth. But modern venture capital behaves exactly like Vishwamitra, using endless funding rounds to keep a loss-making asset suspended in artificial limbo, entirely dependent on cash injections to prevent a catastrophic crash. This is the Trishanku Swarga of most VC-funded businesses of the recent years. This exact friction has brought Bombay House to a standstill. You remember this legendary meme?
इस साइड से आलू घुसेगा, उस साइड से सोना निकलेगा. इस साइड से आलू डालो, उस साइड से सोना निकालो.
This is the investment thesis for quick commerce venture capital. Pass a potato through a funding machine and it will turn into gold at its IPO. BigBasket was never an asset-light Silicon Valley tech startup. It was always a heavy logistics engine of cold storage, regional warehouses, and last mile delivery, simply supported by technology. So if BigBasket was fundamentally a heavy logistics business in disguise, why was it valued like a hyper-scalable digital platform? And why did Tata pay for it like one? When Tata Digital stepped in May 2021, BigBasket was roughly valued at about $1.85 billion. Tata Digital acquired 64.3% stake for approximately 9,300 crores. But look closely at where the money went. Only 1,600 crores was the fresh capital injected into the business. The remaining 7,700 crores was a secondary buyout designed entirely to let the early investors escape. Alibaba, Actis, and a few other investors fully exited. They walked away with 7,700 crores from an asset that never generated a single rupee in actual profits. And the bleeding didn't stop there. To fight back against the quick commerce wave, Tata Digital invested another 4,500 crores post-acquisition. Yet by 2025, Blinkit, Zepto, Swiggy, Instamart captured nearly 94% of the quick commerce segment. BigBasket's market share collapsed from nearly 40% to 7%. Its financial year 25 net loss shot up to 2007 crores. BigBasket was spending 1 rupee and 20 paise to generate a single rupee of revenue. This is the brutal math that crossed Noel Tata's red line. To understand why this tension exists today, we need one piece of context. In 2016, Cyrus Mistry's exit as the chairman of Tata Sons has exposed a fundamental fracture line that has never fully resolved inside the Bombay House. Consolidation versus expansion. Mistry was a strict capital disciplinarian. He focused on cutting debt, writing off impaired assets, and protecting balance sheet integrity. The leadership at that time prioritized global scale. Chandrasekaran, on the other hand, inherited the expansionist mandate. His digital investments, BigBasket, Tata Click, Air India digital transformation, were framed not as an excess, but as a necessary defensive land grab. In an economy moving rapidly online, his argument was simple. If Tata doesn't control the digital pipe, its legacy consumer empire loses direct access to modern Indian. But for Noel Tata, raw math has outrun this strategic narrative, and history gives him a powerful precedent. Has Tata Group taken a massive write-down before? Absolutely. Go back to 2007. Tata Steel shocked the global markets by acquiring the Anglo-Dutch steelmaker Corus for a staggering $13 billion. But when the 2008 financial crisis hit, European steel demand collapsed by 30%. Tata didn't sentimentalize the asset. They took a 20,000 crore impairment and systematically wrote down the value of their European steel assets to near zero. And when history repeated itself in their automotive arm, they ran the exact same script. In 2019, Tata Motors executed a massive 27,838 crore impairment on Jaguar Land Rover due to technology disruptions and headwinds. And Tata wouldn't be alone in making this call for digital tech. India's other great conglomerate already made it. In Jan 2022, Reliance Retail invested 1645 crores into Dunzo for the exact same strategic reason, last mile delivery. But when Dunzo's cash burn became terminal, Reliance didn't sentimentalize. They did not pump in endless capital to keep it suspended in Trishanku Swarga. They cleanly wrote the entire 1645 crore investment down to zero. When Reliance and Tata, two companies at the opposite ends of India's business imagination, arrive at the same corporate instinct, it stops being a philosophy. It becomes a verdict. So what does Noel Tata's playbook look like? You turn off the funding faucets and the Trishanku Swarga fractures. A speculative future IPO that could have handed retail investors a loss-making asset dressed in a Tata suit gets nipped in the bud. The Tata name cannot afford the repeat of a Paytm IPO crash which wiped off 38,000 crores of ordinary Indians' wealth in a single day. Instead, you execute Triage. You look past a broken quick commerce app and extract what is actually worth saving. Because BigBasket isn't just a fleet of delivery riders. Underneath the loss-making engine sits India's most successful private label powerhouse. These brands commanded a massive 40% of BigBasket's entire revenue in the financial year 24. High margin, highly trusted proprietary assets. Noel Tata's playbook doesn't discard them, it rescues them. You merge this private label engine directly into Trent, specifically anchoring it into Star Bazaar's physical and digital retail footprint. And the signal of this shift isn't hidden in just board minutes. It is visible in the talent layout. Reports indicate that Maya Tata is positioned to transition into a pivotal role in the Trent Star ecosystem. When talent follows the direction of capital, it tells you where the conviction lies. For over a century, the word Tata meant one thing to the everyday Indian: trust. Tata companies build steel, generate power, run retail formats that return documented net profits. These profits fund the Tata Trusts, cancer hospitals, and world-class universities. This has given Tata a patriotism premium. Millions of Indians consciously choose a Tata product, cars, airlines, hotels, and even salt because they believe their money stays in India and comes back to India. Two leaders, two visions, one crossroads. Chandrasekaran's thesis is built on the reality of tomorrow. If Tata walks away from quick commerce now, it permanently hands a multi-billion-dollar digital duopoly to Blinkit and Zepto. Scale solves the economics. In tech, you fight the brutal, expensive war today, or you seek the future entirely. Noel Tata's antithesis is anchored in the discipline of yesterday. Real wealth is built on sustainable operational margins, not on a 10-minute potato delivery. Tata's primary duty is not to chase venture capital trends, but to protect its capital integrity. Deploy reserves into core industries of national importance and return consistent documented returns to its shareholders. Stop the cash bleed, absorb the write-off, preserve the trust. If your money were Tata's, whose call would you back? The man who argues that future belongs to whoever controls the digital pipe, no matter the short-term cost. Or the man who argues that a business spending 1 rupee and 20 paise to earn a single rupee has no claim on that capital. Comment Noel or Chandra. And has this changed how you think about venture capital, conglomerate economics, or what the word Tata actually means in 2026? Do share this forward.